If you're a Hims and Hers shareholder, then the last few weeks have certainly been a wild ride. From the mid-20s in January, all the way up to a high of $72 a share and a subsequent crash of 50% on what seems to be blowout earnings. I want to give my take on exactly what happened because there are a lot of investors right now that aren't used to this level of volatility, even when looking at stocks such as Hims, and I want to give my take on the numbers. So, in my opinion, the earnings were outstanding. Revenue of 1.476 billion, so nearly 1.5 billion. And originally, Hims was guiding for 1.2 billion of revenue in FY25 before they reported their FY24 results. They're now guiding for 2.3 to 2.4 billion in FY25, so nearly a double. The most key part of the report that a lot of people are overlooking right now is this bit. Our weight loss continued to scale, obviously. In 2024, revenue grew 43% a year to 1.2 billion, excluding contributions from GLP-1. What does that tell us? It tells us two things. Firstly, that the business excluding GLP-1 is still over 80% of revenue. Number two, 43% excluding GLP-1. Obviously, the shortage is coming to an end. Hims won't be able to use the compounded semaglutide FDA rules anymore because that shortage has ended. But look at this, that 43% growth, right? In December of 2023, this was before GLP-1 was a thing, Hims grew 47.5%, then 45.8%, then they grew 51.8%, but 46% excluding GLP-1. My point is that now, 2 quarters later, they're still growing 43. For a company growing this fast, that pace of revenue slowdown is extremely slow. So what I mean is the revenue growth is extremely sustained. And that's very significant because we're not talking small numbers here. When a company has a few hundred million, it's much easier to grow the revenue at 40% a year. Now we're talking about Hims moving up to 2.4 billion. For them to grow this revenue at 43%, excluding GLP-1, is incredibly significant. And remember, the forecast overall is now 2.3 to 2.4 billion. The analysts were originally expecting 2.1 before the results came out. And what this has done is it has significantly enhanced Hims' valuation, which I will go through in a minute. Just on the qualitative side first, Hims are expanding their categories. We've mentioned this on the channel before, the testosterone and menopause as divisions, they're coming into the Hims platform very soon. So they're definitely proving themselves that they can expand into new categories quickly. And also very interesting, acquiring Tribe Labs, which is an at-home testing facility that's based out of New Jersey. This will allow people to do at-home blood samples, and two things. It will allow them to test for potential diseases that Hims can then help treat, but it can also test for personalized treatment. Hims were talking a lot on the earnings call about things like workout programs, helping people with supplement, working out if someone has a deficiency in something and thus supplementing with a vitamin. So they are taking personalized healthcare to the next level. This is what we really, really love to see. Just let this guidance sink in for a minute. 2.3 to 2.4 billion of forecasted revenue. And don't forget, Hims always beats on guidance and often uplifts guidance throughout the year. That is 56 to 63% revenue growth. This kind of growth with a company making this much money is almost unrivaled. It's very, very rare. And it's showing the sustained value that Hims is creating for its customers. Now, if you can't already tell, I am very bullish on the shares. Of course I am. It still remains one of the largest holdings in my portfolio, even when I took a lot of realized gain, because the value of the company, the estimated value of the business and the price, that gap was closing. It was still quite wide, but not nearly as wide to be 20-30% of my overall portfolio, particularly when the shares are constantly climbing, right? If shares are constantly climbing, you've got to sell those shares just in order to keep that weighting constant, right? This is interesting. Hims, after the crash, right now as I'm speaking, have a market cap of 8.75 billion. They've just reported 198 million in free cash flow. So they are trading right now at 44 times trailing free cash flow. That's not forward free cash flow, that's trailing free cash flow. And those free cash flow margins are far from optimized. Let's go into my DCF to analyze the valuation further. Okay, so what you can see here is my previous DCF as of Q3. And I mentioned that this kind of discounted cash flow does not look at any crazy, complicated financial modeling. This is a base case DCF based off past growth rates and estimated margins and analyst estimates, right? So this was my base case DCF before. You can see here the 2035. This is what analysts were estimating for this year, where HIMS are just guided for 2.3 to 2.4. You get a fair value of $71 a share. And of course, I was looking at this when the shares were at 60. Now, obviously, there's a much greater discrepancy between price and value, but I was looking at this when the shares were at 60. And I was saying, look, the risk reward is not as good here. You'll also notice these numbers actually tail off quite aggressively given this growth. So this DCF is relatively conservative, and HIMS talk about a 20 to 30% long run EBITDA margin. So eventually I think that these 20% free cash flow margins are very, very realistic, particularly with HIMS' other long-term goal, which is a mid-70s gross margin target. If a company is hitting gross margins of 70% with this kind of operating leverage that HIMS have, sales and marketing as a percentage of revenue going down, they should be able to hit 20% free cash flow margins by FY30. I've got it in here. Now, look at this valuation change, and bear in mind this is a change even with diluted shares going up, because the diluted shares increase, right? Also, this may be the old figure. Even if we put in 230 here, fair value is coming out at 67, right? This is the accurate number that they've just reported in Q4. This is the new guidance, the midpoint of the new guidance. HIMS historically beats guidance, right? This is just the midpoint of the guidance. Realistically, this could be 2.5, maybe, but 2,350 is the midpoint of what they're currently guiding for, and we'll see. 59% growth, even though they're only going to be able to sell compounded semaglutide in that form until mid-May. And here I've updated these estimates, and I'm saying 32% growth, 26% growth, and then we tail off all the way from 22 to 12, which is very realistic considering how little HIMS has slowed down here, and the fact that they're still growing 43% excluding any GLP-1, and they've got this crazy blood testing business coming up, which is another potential avenue for them to re-accelerate revenue growth. Now, what's also interesting, and this is a back of the napkin calculation, is on the earnings call, Andrew Dudum said, in 5 to 6 years, my goal would be 10 million subscribers on the HIMS platform. There's currently 2.2 million subscribers, right? So 2.2 million subscribers to 10 million subscribers is a 4.5x on the current subscribers. If you 4.5x this, let's have a look, 1476 multiplied by 4.5x, you get 6642. So this DCF is suggesting, because these two numbers are about the same, that in that 5 to 6 years, if Dudum hits his goal of 4.5x in subscribers, 4.5x in revenue in 6 years, so not 5 to 6 years, but 6 years. And that's roughly what we've got here. Now, that is suggesting, obviously, no increase in average revenue per subscriber, which I think is extremely probable considering the number of people on 2 or more treatments, and the number of subscribers on customized treatments is going up and up over time because there's a greater value unlock there. And also, the more treatments that are on the platform, the more at least 2 treatments will be applicable to any given person, and thus the average revenue per subscriber will increase. As you can see here, no surprises for looking at the bottom, we're now getting a fair value of $94 a share, meaning that we're in a situation where, because of this huge guidance increase from what we were initially looking at and what the analysts forecasted, plus a 22% crash in the stock today, the discrepancy between price and value has massively widened again, and I am accumulating more shares. I've accumulated a lot of the shares that I sold between $50 and $60 just 2 weeks ago. Obviously, none of that is financial advice, and you should not be following my trades. I wanted to make it clear what I was doing, again, because I feel semi-responsible for keeping people that follow the channel in the loop. just because I publish a huge HIMS deep dive, which you can watch on my channel. It's my most viewed video, and it goes into a lot of comprehensive analysis into the company. And I obviously stated in that video that I'd make it my largest holding. This was also interesting, right? It's like in that video, I stated that HIMS has the potential to be a 100 billion company in terms of market cap, right? Before we had the crash of today, we were already at 11 billion, right? Let's say if Dudum can 4.5x those subscribers in 5 to 6 years, and we have a constant market cap per subscriber, which would imply constant price to sales, right? And constant revenue per subscriber. If the stock also 4.5x in the period that subscribers 4.5x. So that would take us close to 50 billion, right? 11 times 4, 44, 11 times 4, yeah, be basically 50 billion. What I'm saying is that if he increases subs by 4.5x in the next 5 to 6 years, at the 11 billion market cap, which we had before earnings came out, and the only reason the stock has gone down is because way too many investors bought this for a GLP-1 craze, as I discussed in my previous video. That basically gets us now to 50 billion in market cap over those 5 to 6 years, which is crazy. It's absolutely crazy. And then you think, where does that other 2x come from? That 2x can come from a combination of increase in valuation and increase in average revenue per subscriber. What's root 2? Is it 1.42? So 1.42 times 1.42, roughly. In fact, let me check. Yeah, so root 2 is 1.41, right? So let's say we have a 5x from the 11 billion market cap, right? Even if you want to call it 5x from 8.75 billion market cap, we're still at 45 billion market cap in those next 5 to 6 years if you can get to those 10 million subs, which based off the trajectory of history of subscribers is extremely possible. Then if we call it another 2x to drive us to that 100 billion in market cap, that can come from a combination of uplift in valuation, and the stock's extremely cheap, trading at 40 times trailing cash flow with 56 to 63% forward revenue guidance, which they will most likely beat, and not even optimized margins by a long way. Isn't that crazy? So if we get 41% uplift in valuation, 41% increase in average revenue per subscriber, and they're actually proving this year, because last year average revenue per subscriber was stagnant, this year average revenue per subscriber is going up. Obviously GLP-1 helps that because they're selling their average GLP-1 for $200 per subscriber per month effectively. But if they can upsell customers to 2 or more treatments and generate something that adds so much value like GLP-1, if they can get that average revenue per subscriber up 41%, or even if they double that without an increase in valuation, that actually gives us quite a clear path from the roughly 10 billion market cap of what it is today to that 100 billion in market cap over a period of 5 to 6 years. I'm not saying that that 10 billion is guaranteed. It was actually not something that was in the slides and something that Dudum just stated, and that's their long-term goal. But again, this is a guy that started the company when he was 28. Look what he's been able to achieve up until now in 7 years. Basically 7 years. It's only the start of 2025, so it's been 7 years. Now he's only 35 years old. Isn't that crazy? And look at what they've been able to achieve. So that there were a lot of people on the video that also said like 100 billion market cap, completely head in the clouds. But you can actually kind of see a path there. So here's something else that's interesting. Here is HIMS forward price to sales, which now it says 4.94 here, but it is much closer to 4 because we've got an 8.75 billion market cap and 2.4 billion forecasted for revenue. Let's just call it 2.4 billion, right? Because they're not going to not hit that upper end of the guidance based off history. So yeah, 2.4, 8.8, it's less than 4 times forward sales now. So if you actually look at that on the graph, it's been at that price a couple of times whenever it's peaked. This is my point. HIMS is really not expensive. It's kind of crazy because we only blew past that $40 share price mark for the first time, very first time, a couple of weeks ago. But yeah, from this guidance, which they would not have said if they weren't confident, and they probably revised it down a little bit because now they have a time limit on doing GLP-1s and doing that segment of weight loss in the same way. They would not release that if they weren't confident that they would beat it. And as I said, like every time all of last year in all the quarters, we had an uplift in valuation all the time. this is the last thing. The short interest as a percentage of float has gone up recently. A lot of investors talking about this, but what's not often mentioned is the short interest has gone up a lot in the last quarter. A huge amount. It used to be 10% of the float. There's a lot of money in short now because it's ballooned to like 30% of the float, which is absolutely crazy. Now, just very quickly, what this means for investors that may not know and the implications for the stock price is these investors that are short, which are predominantly hedge funds, they're betting against the company, right? And they're borrowing shares that they don't own, that they're looking to buy back at a later time. So when they short a company, demand for the shares effectively goes down. The thing is that with shorting, you're selling a share that you don't own. So let's say a hedge fund has shorted shares of HIMS at 20, right? Let's say they've done 1 million shares. So they've shorted 20 million of HIMS, which is crazy. Now, the problem is that if HIMS goes to 40 and they get their short wrong, they're going to have to buy back $40 million of stock, meaning they've lost $20 million on that trade. But the thing is about shorts is that you don't only have the potential to lose all of your principal, i.e. if you're long when the stock goes to zero, you have the potential to lose much more than that. If HIMS goes to 80, they've got to buy back $80 million worth of HIMS stock, meaning a massive, massive loss of 60 million. So the point is about that is that when HIMS rises excessively, hedge funds will cut their losses because they don't want that risk. But the problem is that then hedge funds will all try to cut that risk and then try and buy back the stock at the same time. And it creates a huge amount of demand because all these hedge funds that are short the stock are trying to buy back the stock. And there's only so many shares out there, right? There's only so many shares of HIMS out there. And that's another nice thing about the company is that for such a young, fast growing company, they are net profitable and they're not even diluting at a particularly high rate, a tiny rate, given their growth. And they actually announced a bit of a buyback in this last quarter. So 30% short of the float is very significant. And my point is that when there's a lot of momentum in the stock, this can tend to carry it up, but it's not a central part of the thesis, which is why I mentioned it this late into the video. It is not a central part of the thesis at all. It's just worth noting that if HIMS moves, it will move. So yeah, just to summarize 2025, their top 5 priorities: position HIMS as a weight loss speciality. Okay, amazing. So they're basically saying, remember guys, we have other weight loss products other than GLP-1. Fantastic. That's really, really good. Integrate lab diagnostic capabilities. We talked about that. Very, very exciting what they're doing with that. And they'll be able to get data from this new company, which will make their lab diagnostics much more accurate. Invest in affiliated pharmacies to increase breadth. That's very sensible because they are controlling the vertical, controlling the supply chain. They just have more autonomy over everything and less reliance on third parties. Set the foundation expansion into new specialities. We've seen HIMS achieve on that historically, adding to that platform at a very fast rate. Expand the depth of technological capabilities. They mentioned on the earnings call they just appointed a CTO, which is fantastic. HIMS has always been a technology first company, particularly with things like MedMatch. So in conclusion, I am buying back more shares here, and this is a ride. The shares have negative momentum right now. Anyone who wants to be a long-term shareholder in this company, there is very good risk reward now, but there is obviously a danger of going in guns blazing right now because the shares have had particularly negative momentum and they've crashed all the way from the 70s to 39. It's nearly been a 50% crash. And the market it might be unlikely it gets down to like 20, but if the market does give us that opportunity, it's always worth having some cash ready to go in there. So that would be my conclusion from it. HIMS have had a very strong quarter, and I'm shocked but not surprised the stock's down 20%. It just goes to show you how many investors bought the stock, not really understanding the deep fundamentals of the company and what HIMS are really doing. You know, what HIMS are doing, I talked about all this first in my investment thesis, is they are bypassing the complications and the rules and the bureaucracy of the health insurance industry and bringing an industry into the 21st century. Right, we're used to things fast. We're used to things on our phone. We're used to seamless apps. We're used to online delivery. Gen Z and even millennials, and quite frankly, a lot of people even older than that, are not used to having to walk to a physical building to do something, walk to another physical building to do something, waiting weeks and weeks and weeks. You know, we're used to online delivery, fast communication over the phone. That's what HIMS are doing, right? They have a breadth of products and they're not a weight loss company. And what is nice about this crash is I'm hoping that a lot of HIMS investors that invested solely because of GLP-1, they've been shaking out the company with semaglutide coming off the shortlist, and it gives everyone who believes in HIMS as a long-term concept the chance to purchase more shares at what is a very good discount given the discrepancy widening between price and fair value. And it just means hopefully that HIMS will not trade solely off GLP-1 news going forward. I hope you enjoyed the video. Thank you for watching.